back to another episode of the Smart Money Show. My name is Noman Akhtar, and as usual, I am joined by Ali and Noman. How are things?
I'm good. We are obviously in a new location, which I'm always super excited about. Always means that we're in talks and actually in the middle of another in-person episode, which I'm always super excited about with another professional guest. But obviously, I'm kind of in the middle of my final year of uni, or just in the middle of the start of it. So a lot of pressure on that stuff, but it's always nice to be able to get back on the ropes with the show and get involved with that again with another in-person episode. But before we get into who we're joined by, how are you? How's things with you?
Yeah, all good. I mean, second year, so anyone's in second year, they know that. Or even third year, application season is literally the bane of your existence, isn't it? So, of course, most of my time there, then of course, managing uni started to kick off, and then everything in between as well, right?
Yeah, absolutely.
But anyways, we could talk about each other for hours, can't we? So, let's kick off with the episode then. Who do we have on today?
Absolutely. So we are at Canary Wharf, our first ever office filming within Canary Wharf. For those loyal listeners, it's been on the bucket list for a long, long time. And we are joined by someone who matches the impression that we're trying to give off with this office visit. So we're joined by Olivier Beroud. He is a seasoned business leader, board chair and strategic advisor with over 3 decades of experience across credit ratings, risk management and corporate governance. Olivier is currently the executive chair of ARC Risk Group, the parent company of ARC Ratings and ARC Analytics, and the founder of Beroud Consulting, where he advises boards, coaches executives and supports organizations across the private and non-profit sectors. His career has seen him at the helm of global institutions, which we will get into in this episode. He has served as chair of GCR Ratings, Africa's leading credit rating agency, as well as ARC Ratings in the UK and South Africa. Before that, though, he held senior roles at Moody's Investor Service as managing director and regional head for EMEA, and at Barclays as global head of ratings advisory and risk appetite. He began his journey, though, at S&P, where he rose through the ranks to director and team leader across multiple international offices. Beyond the boardroom, though, Olivier is passionate about education and mentorship, which hits a chord for me and Noman for sure. He directs executive programs, lectures internationally, and mentors senior leaders through the Future Leaders Group. He has also contributed to industry standards through his work with the UK's Financial Reporting Council and his service as trustee and risk committee chair at Stratford Arts Trust. So in this episode, there's a lot to cover, as I'm sure the audience can see. So we'll explore Olivier's remarkable career across some of the world's biggest financial institutions, the lessons he's learnt about leadership and decision making, and of course breaking down the ratings industry as a whole. So without further ado, I'm very excited to welcome Olivier onto the show. Olivier, how are you?
Thank you. I'm very well, thank you. And I'm not sure you're talking about me with all this, but it sounds like I'm very, very old. So hopefully that's not the impression I'm going to give.
Not at all, not at all. Very experienced, I think, is what we'll go for.
Thank you very much. Thanks for coming and giving me the opportunity to contribute to the show.
I appreciate it, and thank you for allowing us to sit in your offices as well. We always do appreciate it. It's way better than an online episode. You can actually talk.
So the conversation always flows like just that bit better. So we really do appreciate it. But then,
good to have you in. Yes, welcome to ARC Ratings and to Canary Wharf.
We really appreciate it. So I'm going to kick off the episode if that's fine with you. So you've had a very, I guess, fruitful career, and let's go back to day one then. So what initially drew you to finance, and more specifically risk?
So I can really place it specifically in one lecture when I was at my first year at my business school in France. And in first year you have all these different lectures. So you try a bit of marketing, law, accounting, all that. And I went to a lecture where a lecturer explained to us about cash flows and how companies would fund themselves through internally generated cash flow, external cash flow, and all that. And I just found it really interesting. And my best mate was next to me, and I said to him, "Oh, that was great." And he said, that was awful. I just thought that was so boring." And I thought, okay, well, that's interesting. And years later, when I joined S&P, I realized that the way S&P analyzed companies was exactly the way that this guy had described his work. So I thought, this is a sort of link there. And so I just followed my curiosity. And I had, as I'm sure we'll come to it in a minute, I had many false starts and thought that, accounting and auditing would be my thing, and it wasn't. And so there was a lot of false starts and a lot of trial and errors. And each time I learned something about what I liked, something about what I didn't like. And even though I did something I wasn't particularly interested for a while, I learned a lot through that. So, it was really sort of happenance as well as following a sort of thread, really.
Yeah. that excites me even more for what we're about to discuss. And we always like to kick off with a question like that because we believe it provides a frame to the picture that we're trying to paint and create throughout this episode. And it leads me quite nicely actually into how we first met, Olivier. So you mentioned a lecture. You did a lecture at the university that I go to, the London Institute of Banking and Finance, and it was a brilliant lecture. I remember we spoke about everything. And I'll be completely honest, ratings it's not on a lot of students' horizons, to be perfectly honest, and I'm sure we'll get into that. But it really helped me realize just how prominent the industry is. The financial services industry as a whole can't run without the ratings industry and that space. So it was super insightful, and we spoke about literally everything, the stuff that can go wrong within the industry as well as everything that went right. And so it's very interesting that you mentioned the lecture being kind of your first insight into the industry, because that was our first insight into getting this episode together. But let's go, continue in that sort of vein of conversation. So were there any pivotal moments or early mentors that you kind of early on in your career or even educationally that really shaped the way that you think about leadership and decision making later down the line in your career?
Yeah, completely. And what's, I think, again, a thread throughout is that the mentorship came both from, managers and people who were looking after me and were senior, but even perhaps more so from my co-workers, people who were in my cohort, in my intake or my year. And when I first joined Moore Stephens, which is the first company I joined in London when I first came to London as a not even graduate, it was a sort of third year internship. And I was taken under the wing of a friend now, a chap called Andrew Gallagher, who just joined, I think, maybe a few months before me, and guided me through how things worked at Moore Stephens and the accounting world, etc. And he's now a partner at Moore Stephens, and I'm not, because as I said, accounting wasn't for me. But that mentorship, as well as the partners at Moore Stephens who were very helpful and very thoughtful and really trained me. That was so important, and then throughout it was the same thing. So people who are responsible for you and guide you and give you feedback, sometimes good, sometimes average, sometimes poor, and also people with whom you work and that you sort of gain ideas from. You open your horizons thanks to observing what they're doing. You also see them make mistakes that you think, I'm not going to do that, and career choices and balance, work-life balance, that sort of stuff. So, I mean, that's, I could cite, a mentor for each step, really. And that's also making friends at work and having, good relationships and keeping these people in your network, professional and personal, which sort of tends to mix. As you get more senior, I think one thing that strikes me is that the strength of personal relationships and the sort of trust you've built of people is really important in terms of seeking advice and guidance, again, from either people more senior, people your age, or increasingly people younger. That's also important.
Yeah, 100%. I think there's two things I can pick up from that. So first of all is that yes, you did starting off a career in finance and having an initial foundation on accounting is always useful, isn't it? And so, I mean, even if you're a student, you can maybe pick a few modules in university. So maybe you might not want to pursue a full career in accounting, but it is something that proves a strong foundation, right?
Yes.
But then, of course, but the main part of your response was how building connections is so important. And I think people need to realize that this is not just like for if you want to have a career in risk or sales, literally any role in finance, especially when you get to the senior levels. I hope you agree to this, but those communication skills are really key, aren't they?
Yes, absolutely. That's very true. And so I guess, the accounting example, for me at least, was interesting because accounting was an enabler. In order to become a financial analyst working in a rating agency, I needed to have spent time in an accounting firm for 5 years. It was hard work and I didn't really enjoy accounting. So I kind of learned, in a way that, I was probably the worst student. I was going to say I wasn't the best. I probably was a worse student in accounting. And but the knowledge that I acquired in that period enabled me then to become a good analyst. So I realized I didn't like to prepare accounts, but I like to analyze accounts. So the enabler was the accounting, and the revelation, if you will, was that accounting wasn't for me, but analysis was. And then in terms of the relationships, the thing is, your network are your peers. Your network, in fact, is not really people above you. They network between them. So everyone networks at their level or below. And from time to time, you're given a break or you're chosen because there's a need. But I believe that the real networking happens at your level. So you can enlarge that network. So when I came to the UK, I had done my first degree in France. So my network was in France. And I came to the UK and I had no network. I knew nobody. I mean, I was literally, arrived, and I was, as I said, helped by, kind people at work and socially who helped me to settle here. But, that network was then enhanced by the fact that I decided to do an MBA where I met lots of people here. And so the MBA became my network in the UK. And that became a network that was useful both because I knew more people, but also because I realized that they had jobs that were more interesting, better paid in industries I didn't know exist. I didn't know that rating agencies existed until I went to the MBA and I discovered, like you did during my lecture, that there was something called a credit rating agency. And two guys worked there, and they were doing the same job as I was doing as a credit analyst in the bank by then, but they had a lot more fun because, in a rating agency, a credit analyst is the main producer, whereas in a bank, a credit analyst is someone who's kind of, stopping business from happening. So it's not really the same function, right? And so suddenly the skill I had, which was analysis, became the central skill and that was a big break, really, in terms of finding a role where my skill set and what I liked doing was the main thing that they were looking for. And so that's, I think, the lesson here, is that, you follow your nose in terms of what you like, and then you find a spot where what you like doing, what you're good at, is what is valued.
100%. But I think now a question I want to ask is, of course, let's move to when you actually started working in the credit rating industry. So your time at Naxos and S&P. So what was that like? How did that build your foundation for everything you've done later on?
So again, arriving at S&P, I had learned very recently what a rating agency was, so I wasn't exactly an expert. And I started as a junior analyst, and I spent 10 years just analyzing companies, working with senior analysts, and working in an environment which was really designed to make you grow and make you progress at every stage. So, every time you do a new bit of analysis, you go through a committee. The committee is a wonderful learning process because you present, people criticize in a positive, but it's a constructive way, but you really getting the feedback straight away, and at the end people will tell you, well, we don't know enough about this, we don't know enough about that, so you could have done better research, more in-depth research. And then people actually follow your recommendation or not. So if they follow your recommendation, then it means that you've got a good, you came with a good appraisal of the risk. So that sounds good. If you realize that they are voting up or down from what you recommended, you realize you've missed things. So, the feedback is constant. And so that's really important because in those 10 years, I continuously learned. And of course, then you also, I was lucky enough to be asked to follow lots of industries that were not very sexy. I mean, all the sexy industries like telecoms and autos were already covered by more senior analysts. So I was given the sort of rump of the litter. Well, I don't mean that in terms of insulting the industries in question. I mean, I love doing it. So I was doing, things like steel, metals and mining, cement. I was doing real estate, all the things that, and through that I really learned a huge amount of how companies work, how the economy functions, and it was very international. So I was traveling to various places to see steel companies in various parts of the world, which is just fantastic. So that's how I this 10 years were really formative at S&P.
Yeah. Those last couple of answers make me feel better about not doing so well in my accounting module, which I think makes me feel a little better coming getting close to my graduation.
Yeah,
but
believe me, you can still have a good time and be a bad accountant.
Amazing. But you've kind of done my job for me and led me into a nice segue into our next section, which is more about actually being inside the credit ratings industry and obviously getting into those roles of leadership. So for those who might not be familiar, how would you describe what a credit ratings agency actually does day to day? You've mentioned briefly, but also where does your passion for it come from? Why do you think you have such a love for the work that you do?
So I'll answer the first question first. So what is what is a rating agency? What does it do? So in essence, there's a triangle which was born in the US where you have people with money to invest. Okay, so they could be generally they're managing other people's money. You have people who are looking to receive the investment, and then you have a third party who gives an independent, impartial assessment of the risk of making that investment. And we're talking about debt. We're talking about credit, so credit rating agency, so debt. So this is basically lending people money, and therefore the risk that you take when you lend people money is that the money won't be repaid or on time or with the interest that were promised. And the interest is set to reflect the risk, right? So a risky company will be able to borrow for not so long a period of time, perhaps, and it will also have to pay more to compensate for the risk, right? So an investor with a portfolio of assets like this, where they make various loans, can compensate losses in part of their portfolio because they're receiving high interests on others. So that's how the industry functions. And that third-party independent opinion is given by credit rating agencies. And this is a system that started in the late 18th century, early 19th century. The companies like Moody's and S&P are 100 plus years old. And this was initially bonds that were issued by the railroad companies in the west of the United States. The projects were in the west, the investors were in the east, and they couldn't go all the time checking what was going on, so the rating agencies were providing that verification, if you will. And over the years, the industry's gone through ups and downs. The most recent down was during the financial crisis, where a lot of the ratings given by the rating agencies were found to be faulty, and there was the great credit crisis, where after that there was a change in the way that they are regulated. So when I started at S&P back in the 1990s, there was no regulation. And when I joined Moody's in 2011, the industry was really still is heavily regulated. So that's a big change in the two. So that's what people do. So effectively, you send a team of a couple of analysts to talk to the company. As analysts, we find out about the company's history, their performance, and then you look at the future and you say, what are you planning to do? So are you an aggressive company in terms of making acquisitions? That's risky. If you are a company that likes to spend lots of money on dividends, that's more risky than if you don't. So think of it as you're a lender, and anything the company that's a bit too racy, too exciting, you get worried about, right? So only companies that are very, very strong, extremely well diversified, and have the enormous cash flow generation can get very high ratings like single A, double A, triple A, which means that they're very, very safe. Most companies in the world would be non-investment grade, but most of them have still very strong cash flow generative powers. But they tend to like to borrow and to invest, and they take risks. That's what companies do, right? So that risk is reflected in the rating. And the last thing to say about the rating industry, which is a bit like the auditing industry, is that the people who pay for the rating are the companies. So it's a issuer, the people who issue the debt, pay model. So it's built on a conflict which has to be managed. So the analysts who work in the rating agency have to be entirely separated from the marketing and the commercial. So when I was an analyst, I had no idea how much the company I was auditing would pay, or if they would pay, and I didn't care at all. It didn't matter. My compensation, nothing was linked to the performance of the company or to the performance of my company. And that creates a really marvelous job where you really are quite independent, and you really are saying what you think, politely, respectfully, but you're really saying what you think about this company. As you're meeting some very powerful people, you're meeting some very, very high, and they have to respect your opinion, and of course you want to justify it, so it's done by committee and it's very careful. But as a young financial professional, it's very exciting to meet all these CFOs and CEOs, and they try to convince you that their strategy is the right strategy. So you meet some really interesting people. And that independence is really key. It's also very important to manage. So now that I'm on the other side managing this is something we really pay a lot of attention to, which is making sure that the analysts are able to carry out their work without ever being mixed up with the commercial side. Yeah.
Yeah, and it's really interesting just to ask a question off the back of your answer, which is, how did you at the time reconcile the fact that you were a young person within the industry and you're talking to, as you said, these powerful people, CFOs, just C-suite and directors, but you're a young person with such an important opinion and perspective on things? How do you reconcile the fact that your age and your experience doesn't necessarily match up with the importance of your opinion and your role? How did you kind of navigate that situation and those scenarios? Just eager to hear that as a young person trying to break into the industry.
Well, I mean, I wasn't on my own, and I would go and visit. So a company, there would always be an MD and a managing director or a senior director in the room. But you would be leading the conversation because you're the analyst who's prepared the interview, you prepare the questions, and also you've been dealing with these people. You've been sending them questions, you've been exchanging, you've been showing them your opinions, and so after a while there's a mutual respect. If you do your job well, the seniority is still there. They're still very senior and it's still very important, and you and analysts are not none of these things, but your opinion will be used very prominently in the decision making process, so they pay attention and they give you respect, time, etc., which is very enjoyable. But it doesn't go beyond that, and there's always someone very senior in the room that is clearly able to, if anything goes wrong, step in. So I don't want to give you the impression that I was sort of rating things on my own from the age of 22. Not at all. But it still gives a lot of exposure, I'd say, to someone young, and if you apply yourself and you're diligent in what you do, then you get respect very quickly from the people you're dealing with. I mean, one of the things that experience helps you with is to deliver bad news. So as I became more senior in my role as an analyst, and I was the senior person at the meeting, the role that I started to fulfill more and more often is the person who announces downgrades. So when you have to announce a downgrade to someone who's very, very senior, that's difficult. So you need to do it with empathy and firmness. And so that's where you perhaps step in as a senior person and you help the junior person, because that's tricky to do. And you could be easily sort of rattled and try to lose your ability to communicate at that point. Yeah. But being a good communicator, really, so being a good analyst and good with figures is one thing, but I was never the best at analyzing in terms of figures, etc. I mean, people are. I mean, I'm no mathematician, no accountant, as we've established already. So, but I mean, at the end of the day, financial analysis for corporates is not that complicated in terms of financial analysis. What's important is to understand the people, and the managers in particular understand the people and communicate with them. So the communication point that you made earlier on, really, we go back to that all the time. Yeah.
But yeah, those were some amazing answers, and for me, it's just the fact that, I mean, looking at the scale of this industry then as well, because at the end of the day, every company is wanting to borrow money from the bank. So of course, that the size of this industry will of course follow through on that fact, wouldn't it? And I guess a follow-up question I want to ask, kind of on with this thought in mind, is that now there are many credit rating companies out there, right? You've worked at many as well. So what differs and what changes are there between two different credit rating agencies then, in your opinion?
So in practice, there are two main rating agencies, both US-based, Standard & Poor's and Moody's, and they are the oldest one as well. So they were there from, and in the US, in order to issue bond on the public market, you need two ratings. Really, there isn't a huge amount of competition corporate ratings. So the corporates in the US tend to be rated by Moody's and S&P. A few of them may be rated by Fitch or others, but that core market, corporate funding, is really dominated by two agencies, and you need two agencies. So effectively, you have a very strong monopolistic power. And then across the world, there's more competition, I think. There's been attempts at creating rating agencies in many countries, but because the financial market is driven by issuance of debt in the US and in Western markets, these two agencies that are also very strong in Europe, for example, really dominate that sector. So there are many agencies, but at the end of the day, The others are competing and sharing into bits of the market as opposed to the core. In structured finance, the competition is much fiercer, and so you have Fitch Ratings, you have DBRS, Morningstar, etc. You have a lot of mid-size agencies that are competing very effectively. And then in the more esoteric, more sort of narrow niche type of market, you have a lot of agencies, including ARC Ratings, where by providing a quicker, more flexible service in terms of methodology and criteria. So for example, let me give you an example. If you want to do a shipping transaction in structured finance or in corporate, Moody's and S&P, for them, shipping is part of transportation. So they would have like one methodology that is a little bit towards shipping, and it would be maybe based on, I don't know, one or two sector of shipping, maybe mainly the container shipping is the biggest one, right? Because for them, it's a massive sector, right? For us, we don't do any ratings in any other area of transportation at the moment than shipping. So for us, shipping is everything in transportation. So we have a shipping methodology that looks at, like 40 different asset classes within shipping. So you're talking about like much more granular attention to types of vessels, etc., which Moody's and S&P couldn't possibly do. It's too narrow. Or they could, but it would need for them to develop a new methodology that is, and why would they do that for shipping and not for, I don't know, some other niche market? So we can focus on the niche markets and be very competitive and be responsive and very knowledgeable. So people in the shipping industry would find talking to us much more satisfying, if you will, than talking to S&P and Moody's, where they would be one of a many, it wouldn't be so specialized. So I don't know, it's a bit like, if you're into, I don't know, you want to talk to a specialist, and you do get pleasure out of talking to a specialist, and they understand you better. And so that's how we compete. So the difference, if you will, is understanding of local markets, understanding of specific sectors, friendliness of the service. When you're talking to Moody's and S&P, you're talking to a huge machine. I mean, I used to be both at S&P and Moody's, and I was doing, I think, a very good job of being friendly and accessible. But you're not as friendly and flexible as if you're working in a small agency, and the clients here know all the analysts. They talk directly to the lead analyst. They're very, very close to the team, and so that makes it a better experience, I think, for the clients. Yeah.
Absolutely, and I'm interested and eager to hear, because you were in leadership roles at Barclays within their rating space, then obviously at Moody's as well. Barclays being not just a rating firm, but Moody's, as you rightfully said, being kind of one of the main competitors with S&P. How was there a major difference in how their kind of cultures and their rating operations operated? Because Barclays is obviously primarily it's a bank, whereas Moody's, as you said, it focuses more on ratings. Was there a difference?
So this is a really good question, but we need to be comparing S&P and Moody's. That's a really good comparison. Barclays, it was an internal rating job. So within a big bank like Barclays, what's going on is that the rating agencies only rate very large companies at the end of the day. The smaller companies that tend to be the bread and butter business of the banks are too small to get a rating from S&P and Moody's, because they don't issue debt. They don't issue debt on the capital public market. So inside the bank, they need to have their own rating systems in order to rate their own exposure. So when they lend to a company, they have to kind of rate that. And so my job within Barclays was to help them to organize and refine their internal rating systems. And in particular, for the new regulation that banks are under, Basel I, Basel II, etc., that became an important aspect. So you have internal rating systems that are accepted, that are validated, and are used by the banks, or you can be using an external rating agency. So that can also happen. But so that job was really interesting for me, because I understood how banks were using ratings in a way that was totally different to the way that Moody's and S&P use ratings, and how with less information you don't have as much time. Because if you think about doing a rating for Moody's or S&P, you actually go to see the company, you spend a day with them, you meet the whole management team, and sometimes you even have a site visit to understand how it works. I mean, when you're in a bank, you've got 2 hours with a piece of paper to get to a rating. So obviously the quality of the analysis is not the same, right? And so these ratings have to be done differently. It's a mass volume activity rather than sort of handcrafted activity. And that was really fascinating and really helped me to understand how the financial system worked from a bank and other perspective. Yeah, so that was really. So S&P and Moody's, they're very, very similar.
Yeah.
The analysts who work there are, they're the same people, and they're just interested in their jobs. And I would, from the perspective of the outside world, I couldn't tell you there's a huge difference between the two. Yeah.
Okay, fair enough. But then the distinction between, of course, working at like a credit rating firm and then like a division of a bank, it is interesting to learn about that.
Yes.
But I guess a follow-on question or a separate question I have. So you mentioned earlier that there were instances where you had to deliver bad news. Could you maybe talk about a specific instance without, of course, causing any unwanted compliance issues? But and then how did you actually follow through with that? How did it affect decision making? Just so our viewers can get like maybe a bit of a case study without any specific names mentioned.
I mean, I can mention the case which just took place a long time ago, but we were rating a company called ThyssenKrupp. It's a German steel company, and S&P at the time changed the way they were assessing one very specific aspect of the balance sheet of these companies, which was that they started to consider that the pension liabilities should be really treated like debt. And up to that point, they had been looked at, but they hadn't been absolutely considered like debt. And after a while, we thought, well, really, this is like a debt-like instrument. It's just like another type of debt. And ThyssenKrupp had a lot of these liabilities, and they were investment grade, but at a low level of investment grade. And by the time we had reviewed the situation with a new methodology, including the pensions, the rating was no longer investment grade. So we had to change the rating and tell them that we were changing the rating not because of something they had done, but because the way we decided to look at them. Okay. So, I mean, if you announce bad news to a company because they've made a massive acquisition, they've decided to pay a huge dividend, or they've had a terrible year, they kind of know what's coming, right? So they can try and argue, but they know it's their own fault, right? Yeah. But it's not their fault, and you have to announce that piece of news. And at the time, and I have huge respect for these guys. I mean, the chairman of ThyssenKrupp was a gentleman called Dr. Kromme, who was also he was I think the chair of the German industry bodies, etc. So it's very, very difficult and very sensitive issue. But at the end of the day, we give an opinion. We're giving an opinion based on our methodology, and sometimes the methodology changes. And so, we thought that it was right to consider pension as a real, liability, and then we couldn't ignore it, as maybe we had done wrongly before. And so, in spite of very virulent complaints and very, very strong pushback, which went all the way to, very highest level, and the press was all over. S&P's name was mud. Thankfully, my name never got into the papers, but I wasn't very popular with ThyssenKrupp, let me tell you that. And so, but you try and be honest and straightforward. So, look, we've changed the way we do it. We understand it's not convenient or good news, but that's the way it is, and we have to follow our own views and opinions. And the same situation occurs when a company tells you, if you downgrade my rating, I will not be able to borrow anymore, and therefore you are precipitating a sort of downward cycle. And so you wouldn't be, following that logic, you would not be able to downgrade the company because you might precipitate a liquidity crisis or something like that. But we're here to give an opinion. So if we are restrained in giving the opinion by what that opinion might might generate, then you never give an opinion, because you can only give good news or good. So you have to be able to deliver bad news. So once you sort of get comfortable with that idea, then you just stay calm and sympathetic, and it's also I understand, but that's what we're going to do.
I can't imagine how. I mean, you mentioned communication a lot. I feel that's a tenet that's come up a lot throughout this episode. But I can't imagine even then, because at some point communication fails. because it's at the end of the day it's bad news, and it's down to the client, as you mentioned, how they take it. Thank you for sharing that. We do appreciate the transparency, and I think it's a great pivot into sort of explaining ratings a bit deeply.
It's all in the public domain. Hasten to.
Yes, yeah, no, of course, yeah, absolutely, and yeah, that's a good preface to say. But yeah, we'll pivot a bit more into more deeply into what credit ratings actually mean. So something interesting from that answer, which was a bit about how independent credit ratings actually are. So that's my question to you: how independent are credit ratings in practice, and how do agencies maintain that independence? I think. Yeah.
So, well, without the independence, the rating is worthless. So you can only, and I think some have tried. If you publish ratings that are too generous, that becomes obvious very quickly. Because actually there are quite a few other rating agencies. So if your ratings are consistently better, then the analysts out there, the investors, will discount your rating. The central banks will discount your ratings. You will be told that you're not supposed to use ratings from X agency because they're not reliable. So you end up by basically destroying your own business if you're not independent and rigorous and give the rating that should be given out. So the competition, as far as we're concerned, never happens on the rating level. The competition happens on the quality of service. Yes, the creativity of when you're rating entirely new types of assets, and with all the changes in the technology and the requirements for the funding for data centers and things like this, and again going back to shipping, there's also a lot of different ways in which shipping can be funded in the future compared to the traditional way in which shipping is funded today. So you have lots of innovation that can be brought to bear without lowering your criteria. So it's a sort of self-fulfilling prophecy. If you are playing with the rating levels and you're not independent, you can lose your credibility, and if you lose your credibility, no one wants to use you. It's just as simple as that. So yeah, it's a very simple equation.
Yeah. So throughout this conversation, anyone who's read about previous crises that's happened, and I guess the most recent one, 2008 included, credit ratings, they've had a strong name within that space. So could you just describe to me what has happened during these crises and how have you managed it?
Right. So you're not the first one to ask that question, and it is of course a very relevant question. So the issue arose in 2006-07. The famous pictures just here with the guys leaving their Lehman Brothers offices with the boxes in front of them and having lost their jobs, etc. I was in 2006. I was working for Barclays, and so I was no longer working for S&P, and then I joined Moody's after in 2011. So I spent my crisis, if you want, at Barclays, and so I could see firsthand how the market reacted to the loss of trust and confidence in the ratings that were out there, and the issue was really focused on structured finance ratings. The corporate ratings that I was involved in, didn't ever suffer from the same quality issues, and the quality issues of these, which are actually a lesson that we could apply to a lot of the opaque funding that's going on at the moment in private credit, for example, was due to a lack of transparency. There was a lot of hidden debt. There was a lot of special purpose vehicles that were being rated AAA when the collateral wasn't being checked properly. So it was a series of bad practices that the banks and the rating agencies had let through, and the method of verification, the checks, the market was extremely hot. So people were rating things very quickly. People at rating agencies, were very quickly poached by investment banks that were putting the transactions together, and so the analysts at rating agencies didn't stay very long. There was a lot of turnover in rating agencies. So the quality, the knowledge there was an imbalance, in my opinion, in terms of what was going on in the banks and what was going on. And many of my colleagues at S&P left for investment banks, and we had to recruit new people, etc. So that's all the things you need to watch out for. But the fundamental change since then is the regulation. So, regulators really stepped in to ensure that some of these practices would not be allowed to continue. I mean, having said that, the next crisis is one that the regulators will do something about as soon as they've understood how the crisis has taken place. And of course, they can prevent some, but the financial sector is such that the creativity, the enthusiasm, the lure of returns is such that you always have a risk that things overheat. So it was a big shock, and to a certain extent, there's still a lot of inheritance from that in terms of the debt that was accumulated. So not a very good time for the rating agencies. They lost enormous reputational. Their brand was very damaged, and so they had to work very, very hard at rebuilding it. And one of the things I did when I went to Moody's was specifically to improve the transparency and replace, if you will, and it was not just me, it was the whole agency wanted to do this, so replace the role of agencies as one of the factors you consider when you make your own mind. So this is an aid to decision making as opposed to the only thing you should use to make an investment decision, which was always, that was an idiotic thing to do. I mean, you can't just look at the 3 letters and decide you're going to invest. And I think many investors had really cut all sort of self-analysis they did themselves. So they would rely on ratings blindly, and that's not a good thing to do. So nowadays, I think you have a lot more skepticism. Ratings are used as a way of maybe differentiating, but then people have to do their own homework, and I think the industry as a whole has really improved in that sense. With private credit, the transparency is more difficult to achieve. So if you don't have the data, it's difficult to analyze. So that's something to think about.
We've never platformed the financial crisis from a ratings perspective. We've always asked that sort of question to people who have spent years in investment banking, as you mentioned. But to hear it from that perspective is super eye-opening, right?
Yeah, I mean, I remember I've asked this question to consultants, investment bankers, asset managers, on and off the podcast. That was a really interesting response.
Absolutely, and it leads me quite nicely into probably the next. We've put 2 golden questions back to back, and it's more about your perspective on things. So, knowing what you know about how the industry has coped within these crises, but also what you know now through an illustrious career, if you could redesign the global rating systems from scratch, what would you potentially do differently?
So that's a difficult question because I give you perspective. So when I first joined S&P in 1996, we would receive a request for a company to be rated. They would send us the annual report to the post. Okay, we would receive 5 years. It would be that thick, right? 5 years of annual statements 3 or 4 days later, or maybe by courier same day if you're lucky, right? And then you have to go through it. And then you come back to them maybe 10 days later. You've read the annual report and you're ready for a conversation. Then email, internet. When I first started at S&P, people were wondering whether analysts should have access to the internet because the internet was a waste of time, right? Yeah. I mean, it was only stuff that wasn't particularly interesting on the internet or too interesting. So you imagine the difference between a few years later when you got a call to meet with a company for a rating and they assume you've read all the annual reports because they're on their website, right? So they don't wait for 10 days. They just want to meet you the following day or whatever, and then they assume you've read it, right? And then now you have AI that can read annual reports and produce, the key ratios and a summary of the company within a few seconds. So imagine that. So to say how would you go back and change? I mean, it's difficult to even imagine the different the evolution of the technology that already they have to deal with now. But to try and answer your question all the same, I mean, effectively, one thing that shouldn't change is the fact that it is a committee process, and that learning process that I explained earlier on and I went through is how analysts learn their trade, their skill. So hopefully AI is not going to replace too many young analysts because they won't go through the process that I've described. So that's one potential issue that we're facing in the future. But that should stay the same. And the discussion, the process of, we sort of 5 of us in the room, and I remember as the chair of the rating committee, I was told that when I first started to chair rating committees, if everyone agrees within the first quarter of an hour, this isn't a good thing. So you as a chair need to come in and say, well, I'm not sure about this, I'm not sure about that, I want to talk more. And you go and you question and you make sure that people have a really good debate. Because in the course of that debate, things will come up. And people say, yeah, that's true, actually, I'm a bit worried about that. And you write it down. What are you worried about? Why? And then you go back and you ask the company. And that's how the analysis becomes more interesting and richer. And the other thing to say about this is that the method in which people discuss things in committees is very interesting. So the most junior person speaks first.
Wow.
Okay, so that's fantastic because first of all, you hear something new. So if someone who's 25 talks about an AI, driven company, they will have a view on it that is totally different to mine, and probably their view would be just as insightful, if not more, than my view. Right. So that's the first thing. I, as a chair, I'm going to learn something new from the younger person. The second thing is you hear how well they're doing, because they're explaining what they think, etc. So you can see they're making progress or not. Right? They are working hard or not. I mean, you can see all that. And of course, it means also that they say what they think, as opposed to copying what their more senior and their bosses have said. Because if the boss speaks first, then game over, right? Everyone's going to say the same way. So that really is a very valuable way of building, and each time you see it, you say, that person has said something that made me think, and we should change our view, or we should investigate this a bit more. So that process shouldn't be changed. That takes time. It's time consuming. People have to receive the information. They have to read it. They have to think about it. They have to spend time discussing it. So that takes time. And one of the problems with the financial crisis is that people did not have enough time. There was too much pressure in pumping out new transactions. And that's something to look out for. So if I were to do something differently, I would definitely slow things down.
I mean, that is really interesting because even me, myself, my, I guess, misconception on the credit rating industry was it was more so strictly number crunching, and then that flows through to a rating, whether that be Moody's, S&P, ARC, whatever. But so that is interesting that there's a stronger people's element within it. So, but I think this is a good segue into our penultimate section of the episode. No, actually, no. The third last section of the episode. We've got two good sections left, but I wanted to ask now. I think going off the back of what I've just said, how there's more to it than just the number crunching. Now, I think a hot topic these days, especially if anyone's taking any finance modules, this 3-letter acronym comes up, ESG. So do you think that will carry any weight or any stronger weight in the future when it comes to rating companies?
That's a really good question. So ESG, there's sort of two topics. There's one, how do we factor in ESG factors into credit rating? That's the first question. And as far as I can think. The second question is, can you have an ESG rating of its own? So I'll tackle that question first. So there's been a lot of attempts at creating ESG rating companies, which would give ratings specifically on ESG factors. And that is a very difficult challenge, because whereas credit analysis is, frankly, for a corporate, it's very simple. I mean, you spend 2 hours with me, you can start working. It's not difficult. What's difficult is to have comparisons across the globe. Making sure we do peer benchmarking, making sure we have trend analysis, making sure we understand where management comes from, etc. So there is more to it than just number crunching. But the number crunching in itself is very simple. With ESG, you're not talking about one company and how much debt and how much cash flow it's got, right? With ESG, you're talking about things that are so incredibly complicated. I mean, the environment, the climate. I mean, how do you predict? How do you anticipate? It's because a rating is all about the future. As I said during the lecture, if you can analyze the past, that's interesting. But if you can tell me about the future, now you're talking. Right? Now you're talking. So it's ESG. How can you predict the future? We know it's going to be tough, but where, how, how quickly, how much is it going to cost, who's going to be impacted first, who's going to have to pay? I mean, all these are very complicated questions. So you have a myriad of complicated questions to factor into 3 letters. So already it's complicated to do it with, we have this very simple letter, scale. But for ESG, I mean, so Moody's and S&P have done some very good stuff on this, but their scale for ESG is super complicated. For E, for S, and for G, you have sections where you have ratings for each of them, and then I mean, by the time you finish, it's like you don't know where you started. It's how do you make decisions? Because again, the only purpose of this is to make a decision, to differentiate between am I investing in one bond, or am I lending to one company or another with the same rate or with the same rate of interest, or am I charging this company more rather than that one? You want to make a decision, but that's what the rating is for. So if the ESG gives you a warm feeling that you're doing something for society, but doesn't help you to make a decision, what's it for? Right? So that's just E. I mean, social. I mean, so then the question is, how, if it's that complicated, how do we then apply it to credit ratings? And to a certain extent, you apply it because you have to. If it's going to impact the cash flows. And I remember writing a research back in my, I think it was Moody's, early Moody's days, with a young analyst who's now an MD. So it just shows you how old I am. But he was just starting, and we wrote together a piece on water scarcity in the mining industry, because we just had a couple of cases in Latin America where big rating companies, I can't remember which one it was, but it had to close down a mine in Peru, or I think it was in Peru, it was a copper mine somewhere, and they had to close it down because they were pumping the water to use in the mine, and that meant that the wells for the local community had dried up. So you can impact the environment with dust for years before anyone says anything about it. But if the water runs out, after 3 days, you've got a riot, right? Because how do you, right? You can't survive without water. So suddenly they had a revolution on their hand, and they had to close the mine, right? And so the solution was to bring water. Now this was in the mountains, to bring water from the sea, pump it up, to use it in the mine, and that cost 300 million to build, and meant that the mine became because the operating cost was also very high. So water scarcity meant that a massive project where they'd invested billions of dollars became non-economical. So this is an early, this was before ESG was even a thing. So we've always factored in ESG factors. This was E, environmental; S, social; G, governance, because someone had made a pretty poor decision to not look at how the water would be affected for the local community. So all this stuff, that was all baked in the rating because there was an impact on the cash flow. But can we then say that a credit rating is a good proxy for ESG? Not really. Not in the sense that people were trying to use ESG ratings to direct funds and investment. So that's a very difficult thing to say. And some people are doing some very good things, but I think you need to focus on, say, climate, and that's one area where you can really add value, and then you can maybe look at other aspects, biodiversity, etc., and try and predict how that might impact. But what we're doing is very simple. We're trying to determine how cash flows are going to be impacted, and how that's going to impact the repayment to the lenders. So we're very, very modest, very simple. We don't try to be too clever. ESG is very difficult. Yeah. It has to be factored in, but it's very complex.
Yeah, and hopefully there'll be more sort of theologies almost about how to deal with that, because ESG is, to an extent, it's super subjective. It's not like a traditional finance.
Yeah. That's exactly it.
It's because
it's very emotional as well. Very emotional.
Sure, yeah.
So whereas cash flows tend to be less emotional.
Well, it depends who you're talking to, I guess. Yeah.
So, it's, as you said, it's interesting your use of the word theology, because there is a certain aspect of even politicizing the work of the credit rating agencies, which the credit ratings have been very careful not to get involved in. And also there's been a lot of people trying to do things and providing opinions which are not always very well researched. So whereas if you compare the rating outputs from credit rating agencies, there's a very strong correlation. So Moody's might come at BB, S&P might come at BB+, but most of the time it's roughly the same outcome. In ESG ratings, there were a number of studies that demonstrated that the correlation was non-existent. So one would say this is single A, the other one would say it's a single B. And it's like, okay, so why? And so you have to look into a lot of detail about the criteria, what drives it, and again, how do you make a decision based on that?
Yeah, I think we'll leave it there, because that was super interesting and definitely food for thought, I think, for us, but also for our audience. And it leads quite nicely into our penultimate section, Olivier, which is, we are now in ARC's offices. Thank you again for having us. And we want to discover where ARC fits into the industry, but also how you ended up here. What the decisions kind of factored into your role here now. So you're now executive chair of ARC Risk Group, which is what I mentioned at the top of the episode. So can you tell us a little bit about what the firm does and how it fits into, as I mentioned, that wider financial ecosystem? Why did it stand out to you?
Thank you. Yes, no, with pleasure. So, I mean, as you now know, I stumbled across the ratings world because I met two now friends who were working for S&P at the time when I did my MBA, and I was working for a bank at the time. I was a credit analyst, and I realized that there was credit analysis, and credit analysis, if you did it for a rating agency, it was more interesting, more enriching. And I described to you how my career evolved, how I learned and enjoyed myself. And then when I got to just before the age of 50, I was at Moody's, and I thought, I've worked for big companies all my life. I'd like to try and do something a little bit more entrepreneurial and sort of do something for myself. So I sort of set out to have more of a portfolio career, and I continued to work with Moody's in providing training on ratings, which is partly where the lecture that I gave to you and your classmates comes from. And as part of this portfolio of activities, I was approached by a rating agency in South Africa, GCR Ratings, which I always had a fascination for Africa. I was in charge of the African continent through my EMEA role at Moody's, and Africa really needs to have more ratings to help the capital markets to develop, companies to access capital, etc. So it's always been a big project of mine, which partly satisfied with Moody's, but with GCR, that was really a way to make sure that a rating agency based in South Africa, but also in Kenya, in Nigeria, in Ivory Coast, in Senegal, would be able to provide that service. So I joined the board as an independent non-executive director, and with a few colleagues, ex-Moody's, ex-S&P, ex-Fitch, we helped the agency to continue to progress and rise. And the founder of that agency, a gentleman called David King, approached me and talked to me about ARC. And ARC initially was an idea of bringing together a number of rating agencies from emerging markets to join force together. So there was one from Brazil, one from Malaysia, one from India, one from South Africa, and maybe I'm missing one. I think there were 5. Anyway, so they got together, and the idea was to develop joint methodologies, and then so say a company, say in Brazil, could talk to a company in India, and exchange information, etc., and not have to go through Moody's or S&P. That was Dave's vision, and that didn't work. It was a great idea, but it didn't work for a number of reasons. It's very difficult. I mean, it's really hard to get analysts to agree on anything. They all have their own minds. That's what you pay them for. They all are very independent and they're very stubborn, etc. And so if they're in the same company, at least they understand they have to play by the same rules, use the same methodologies, discuss things at the same committees. If they are part of 2 different rating agencies, to do that is really difficult and nigh impossible. Different languages also very difficult. So you have to force everyone to speak English all the time. That's again very difficult. So a lot of difficulties, but also each of these agencies had an interest in trying to do alliances of their own, etc. So anyway, so ARC, its initial purpose was, not actually working. So Dave and I had a conversation and said, what do we do? By then I was an independent director here at ARC. And so we decided to build a new agency that would be focused on esoteric, very specific, specialized asset classes like shipping, like a lot of structured finance products that are very specific to and innovative. And so that was maybe 7-8 years ago. Oliver Howard, the current CEO of ARC, joined 4 or 5 years ago from Barclays. Banker is like very dynamic, extremely entrepreneurial, and basically it's a story of doing the same thing from a different perspective, doing it from a very small base. So as opposed to a huge company, we are we 60 people, and we have offices here in Europe, in Hong Kong, and soon in the US, and so it's a really exciting sort of doing again, using the skills, using the knowledge, using the contacts, but doing it from a totally different perspective. And it's exciting, and it feels new, and at the same time familiar. So that's my story of my involvement with ARC, and I'm really having a lot of fun, and I'm working with some very great people, very, very, very clever, very dynamic, very entrepreneurial.
Yeah, and again, that does seem amazing because, of course, moving from a, I guess, more stable, more structured career to more entrepreneurial roles, like there are huge differences, right? So, but then a question I want to ask is then how does your day-to-day now differ from whilst your previous roles then?
Well, I mean, so nowadays I don't do any analysis anymore, and I miss it, but I'm on the wrong side of that divide we talked about. I'm on the commercial side, so I have and really my role here is to help to grow. So the aim, the vision for ARC is to become the 4th global rating agency, and by that we mean a rating agency that can help its clients wherever they're based in the world, so Asia, Middle East, US, South America, etc., and Europe, obviously. And so the way to do this is to go and obtain licenses and be regulated by various regulators around the world, and therefore be able to accompany our clients with transactions where they would have investors coming from all these different centers in the world. So we don't want to become the 4th largest because we have some very big competitors, but certainly we want to become the most diversified and the most global in terms of how we can help our clients. So it's a very focused niche strategy, but it's also very ambitious in terms of where we're going to go geographically. So we as I said, we have an office in Hong Kong already, soon in the Middle East and in the US, and the company is growing very, very nicely. We've always been profitable. We're very focused on cash flow. We don't. I mean, this may look palatial to you, but believe me, it's nothing compared to some of our competitors. We're very modest in our offices. We all crammed in we have one commercial office and a bigger office for the analysts, and a different office for the analytics guy. So we have not only ratings, but also we use a lot of the knowledge and a lot of the skill set and the output of the ratings into an analytics subsidiary, which selling models and data and so sort of to banks that don't need a rating, but they need the tools and the technologies to do their own analysis, for example. So there's a lot of exciting development, and AI, of course, is a big topic in terms of for us using AI to bolster our growth, to be able to scale up more efficiently in a more controlled manner is very important.
Amazing. So, Olivier, we've covered a lot in this episode, not just your thoughts on the industry, but also your personal career and what you're doing now, and really do appreciate your time as usual. But we're going to close off the episode, which we're really excited to watch back, actually. I think I'll need to watch it back with a notepad and pen to take notes. But the final 3 questions of this episode are questions we ask to every single guest. And it's a chance for you to reflect on your journey, but also for us to reflect on the episode. And we feel the audience learns a lot from the answers to these questions as well. So I'll kick off with the first one, if that's okay with you, Noman. So looking back on your career journey, as we have done through this episode, what stands out to you as being something that you're the most proud of?
Most proud of? I should have prepared this because you asked them for every time, so I should be prepared for that one. Most proud of? I think what I'm most proud of is the life-work balance that I think my wife and I have managed to achieve. Although I think she probably would say that she carried a lot of the burden when we have 3 children, and so she was very instrumental in me being able to dedicate a lot of time to work. But I think the rating agency gave me a chance to not work completely mad hours. So the city can be a punishing place for long hours. And I think rating agencies were, I did a lot of travel. That's true. So you have to ask my wife whether that's a good answer. But I think the choices in terms of staying true to what I enjoyed and I think that's what I'm. And anyway, there's some really really amazing stories of things I've been to see and people I've met, etc. So on the whole, I'm proud is perhaps a strong word, but I'm sort of happy with the way it worked out in terms of the choices. Yeah.
Good. Yeah. I think work-life balance is something that scares students sometimes when looking to get into this industry, but it's good to know that that's something that you highlighted, and we don't talk about enough on the show, to be honest. Where a lot of focus on the work as the market teaches us to be, I guess, and as university teaches us to be.
You've got to be ready to. It's a long haul, as it took a long time for me to really learn my craft at S&P, and of course, some people do it much quicker, and they have the ability and the time. But I had kids early in my life, and so it was important to be able to also be with them. So in a way, that's given me a rhythm that I'm kind of happy with now. I'm glad, but again, it was like when you kind of have to do what you have to do, right? So, that was. I think they were okay choices.
Yeah, and of course, everything else you said, like. Yeah, it was easy to probably say in hindsight, like you switched from, you came to the UK, then you switched from accounting to multiples ratings, and the movements between your firms as well. But of course, during the time, there's also been huge decisions, right? So the penultimate question of the episode is then, if you could give yourself, your younger self, you can choose which or what age, any piece of advice, what would it be and why?
I think what I like to do better is whenever you leave a company, and that's really an advice I now try and give to my younger self, if you will, when I see that situation, is that it's okay. People do leave companies, and it's not the end of the world. And I was always very emotionally worried about leaving the company because I invest so much and I get to know people very well, and I really like them. And then leaving the company feels like a huge deal. And actually, it isn't a huge deal. It's okay. And in fact, when you go, you become an alumni, you become an ally, you become a client, you become a supplier, maybe a competitor. But the industry is small. You get to know people. You get to get references. So give people plenty of time when you leave. Give them warning. Explain what you're planning to do, and people react very well. I mean, most of the time they won't be nasty. They won't be angry. You give them time to prepare. It's a much better thing to do, and that's a bit scary. And I never really did it quite right, and I think that's something that's hard to do. But in fact, you need more self-confidence in saying it's okay. People understand that you may want to move on, etc. So I've seen other people do it much better than me, and I think that's a good piece of advice to give. Be open, be transparent, and most of the time people are worried because if they announce they're going to leave before their bonus, they're worried about not getting their bonus, and that's something you have to think about. But even in that context, try and give yourself and your employer as much time as possible, and then you build a stronger network, and you build stronger alliances. People want you back. People want to continue to work with you, etc. That's something that I found always very difficult. And I haven't left that many companies, but I have moved around a bit, and so I remember each of these decisions to move on and how emotionally difficult that was.
And again, that is amazing, because I think there's this weird, I guess, assumption that when someone does leave a company, it's just you just walk out the door, you don't look back. But the way this industry is, that isn't the case,
exactly.
Isn't it?
Yeah, that's exactly how you think. I agree with you. But that's, if you think of it, that's nuts, right? Because obviously you're going to keep these. I mean, especially with LinkedIn these days, you never lose touch with anybody, right? So and that's the thing that didn't exist. I mean, LinkedIn is a fun. I mean, it's so amazing, really, because it maybe reinforces that point, I guess.
Yeah, 100%. And then I guess the final question of the episode, I'm going to see if
I'm just very nervous now because they were all very difficult questions.
I think this will give like a nice overview of the episode and your story. So what is the biggest takeaway you want our listeners to get from your story then?
I mean, I was thinking because you did tell me about thinking about reflection on leadership challenges, etc. One thing that struck me when you gave me that question in advance was, we've mentioned that several times, but the things we're exposed to, the sort of risks or the new opportunities, the technologies that we are faced with now, none of them existed when I was in my mid-30s. So some of them have sort of come up in the last 20 years, at incredible speed. And maybe, I was recently at a Bayes Business School discussion on AI, and one of the professors who just retired there said he was working on AI in the 1970s. Wow. Right. So, you think, okay, well, the future was already there, but, as usual, it wasn't evenly distributed. Yeah. Right? So AI is not a new thing. But as far as I'm concerned, and the impact it has on what I do, it's kind of new, right? And so, we're thinking about the best use of AI, how to give guidance internally, how to maximize the use without taking too many, not sharing IP issues, and all this. Every company is grappling with that. So these are challenges that are kind of entirely new. IP is not new, right? It's as old as the first, poet, But the way in which there's links between, if you use someone else's IP and you put it in ChatGPT. What are you exactly doing here with the IP? Have you how did you control? It's all very complicated, right? So I think that the challenges for leaders in the future are such that, as a leader now, I need to get my cues from, a very wide-ranging source of advice and people, and that really, for example, the importance of reverse mentoring is really important these days, especially as we tend to work longer. So, I want to carry on working for a long time, but by then most of my peers might have retired, and my network will only be composed of people who are younger than me. So this is reverse mentoring, or mentoring, but with a reversed sort of age. So all that is really changing perception and changing. And you were asking me earlier on, how did it feel to be so young in the room with? But already then, that was a new thing. And yes, it meant that very senior people in very large industries were not used to being questioned by young analysts. But that hasn't changed. If anything, they're getting younger and younger. So I think there's a lesson there in the way in which you have to tackle the challenges and how to get ready, and how you exercise your responsibility, your duty of care for your staff, for your company, for your shareholders. That's quite exciting, quite a challenge for the future. Yeah.
Absolutely. And Olivier, I think if we're going to end off an episode, that's how you do it. It has been an absolute pleasure to reflect on your journey with you, and thank you again for joining us for this amazing episode. Noman, I'm rarely speechless, but I'm a bit speechless after that last answer. Is there anything that you'd want to add?
Every episode we filmed, our goal is, let's demystify this industry, different careers, give out advice, and then everything in between. And to be honest, we've ticked those boxes several times throughout this episode.
I know you're super busy, and which is why it's been a while to get this booked in, but it was very much worth it. So thank you again for inviting us into your offices as well. And for our viewers and listeners, if you are watching us on YouTube and you haven't subscribed already, then I'm sure Olivier has given you a brilliant episode to subscribe for more episodes just like this for the Smart Money Show. Same goes for those who are listening to us on audio platforms. Feel free to leave us a comment or a rating, and let us know if there's someone that we should be speaking to that we haven't spoken to yet, or a topic that we should cover on the show that we just haven't seemed to got around to covering yet. And as usual, please do show us some engagement on our social media platforms where we announce events. We're announcing some events where we're going to be touring the UK soon, as well as opportunities to join the team at the Smart Money Show. And talking to the team, thank you to Nico and Usman for being behind the scenes today, members of the Smart Money Show team, and for helping to put this together. We really do appreciate it. But as usual, we'll see you next week for another episode of the Smart Money Show. But until then, take care and please stay tuned. Thank you.